welcome to the Deep Dive. Today we're taking a closer look at a company that, well, plays a huge role in how many of us travel. Booking Holdings, Inc., ticker BKNG.
That's right.
This isn't just, the website you might use for a hotel. It's a global powerhouse in online travel, operating a whole stack of major brands.
A big stack.
We've gone through a pile of your source material, financial analysis, market data, company reports, and our mission today is simple. Cut through it all, extract the absolute most important insights.
Okay.
We want to give you the shortcut, basically, to getting really well informed about this travel titan.
Yeah, think of us as your guides through this info dump. By the end of this, you'll have a solid handle on their core business, how they actually make money. It's quite interesting. Across their brands, where they stand competitively, what their recent financials look like, and there are some, let's say, unique aspects to their balance sheet we need to unpack.
Okay.
Plus their strategy going forward, future growth plans, and of course the big risks they're facing. All pulled straight from the sources you gave us.
It really is fascinating to dig into a company whose services, touch so many people's lives. Okay, let's get into it. So maybe start with the basics. Who exactly is Booking Holdings, Inc.? We know Booking.com, obviously, but what else falls under this big umbrella, and what's their fundamental business model?
Okay. So according to the sources, Booking Holdings bills itself as the world's foremost provider of online travel and related services. It's really a portfolio company. It owns and runs several distinct brands you probably recognize.
Like?
Booking.com, of course, but also Priceline, remember, the negotiator.
Oh, yeah.
Agoda, which is big in Asia. Kayak for meta-search. Rentalcars.com. And even OpenTable for restaurant reservations.
Wow, okay. That's a pretty significant collection of travel and, leisure brands.
Yeah.
How do they actually tie that all together to make money? What's the engine?
The core model, it's a multi-sided marketplace. Basically, they're the intermediary. They connect travelers, consumers like you with this huge network of travel service providers, their partner. And this is across 220 countries and territories. So hotels, vacation rentals, flights, cars, restaurants, the whole 9 yards.
Got it. So they're the bridge. People want to travel. They need services. Booking provides the connection.
Precisely. And where the money comes from primarily is commissions on the transactions they facilitate through their platforms. They use a mix of models. The sources mentioned merchant models, where Booking takes the payment up front and pays the partner later, and agency models, where the partner collects the payment and Booking gets a commission.
Okay.
They also make money from advertising services, on sites like Kayak, plus OpenTable reservations and other little add-ons, ancillary services like travel insurance.
Yeah.
And a really key insight from the sources is how asset-light they are. They benefit massively from the scale of the travel market without actually owning the hotels or the airlines.
Right. That asset-light approach seems really powerful. Less capital tied up in, buildings and planes.
Yeah.
Do they have a stated mission?
They do. It's pretty straightforward. To make it easier for everyone to experience the world.
Simple enough.
And this is backed up by core values like integrity, innovation, diversity, and this idea that the whole group is greater than the sum of its parts, reflecting how the different brands work together.
Okay, so how does that mission translate into their big strategic focus? What are they actually building towards for the future?
A really central theme in the sources is this vision for a comprehensive travel ecosystem. They often call it the connected trip.
Connected trip. Okay, what does that mean exactly?
It means going beyond just booking, say, a hotel room in isolation. The goal is to integrate everything: accommodation, flights, car rentals, maybe tours and activities, even payments, onto one single seamless platform.
So really a true one-stop shop for the entire journey from start to finish.
That's the idea. And they plan to use their huge amount of data and AI capabilities to personalize the whole experience, to anticipate what you might need, offer tailored recommendations.
Like before, during, and after the trip.
Exactly. Planning, booking, while you're traveling, even afterwards. The aim is clearly to boost customer engagement, capture a bigger slice of your total travel spend, build loyalty, and ultimately just make their competitive position even stronger. It's moving from just being a booking site to being more like a travel companion platform.
That makes a lot of strategic sense. Capture more value from each customer, keep them coming back.
Yeah.
Just for a bit more context, any other key identifiers? Where are they based? Who's the boss?
Sure. Headquarters are in Norwalk, Connecticut. They trade on the NASDAQ. Ticker is BKNG.
Got it.
And the CEO is Glenn D. Fogel. He's been CEO since 2017 and also CEO of the Booking.com brand itself since 2019. But he's got a really long history with the company he joined way back in 2000.
Wow.
Yeah, and the sources note he was deeply involved in a lot of the major M&A deals that actually shaped Booking Holdings into what it is today. He comes from a finance and deal-making background originally.
Okay, that gives us a solid picture of the company itself. Now let's zoom out a bit. Where does Booking Holdings fit in the wider online travel market? How big is this space, and is it still growing?
The sources give us some pretty specific numbers here. The global OTA market, online travel agency market, was estimated around $612.95 billion in 2024.
$600 billion, that's substantial.
It is. And looking ahead, it's projected for pretty solid growth, expected to hit over $1 trillion. 1,003.13 billion to be precise by 2030.
Wow, over $1 trillion.
Yeah, that represents about an 8.6% compound annual growth rate, a CAGR, specifically for the OTA segment between 2025 and 2030.
So still strong growth ahead. What's actually driving that growth?
The sources point to a few key things. Continued increases in internet and smartphone use globally, just more people online, more people with smartphones.
That makes sense.
The convenience factor, people prefer self-service booking. Rising disposable incomes in many parts of the world mean more travel, both domestic and international, and the sheer dominance of mobile bookings now.
So basically, more people online with more money wanting the ease of booking travel on their phones.
Pretty much sums it up.
Okay. With a market that huge and growing, I imagine the competition is pretty intense.
Mm-hmm.
Who are their main rivals?
Oh, definitely. It's a very competitive landscape.
Mm-hmm.
Based on the sources, which focus on the big, publicly traded global players, the top three competitors usually mentioned are Expedia Group,
Right, EXV.
Airbnb Inc., ABNB,
Yeah.
and Trip.com Group, TCOM, which is very strong in China and Asia.
Okay, Expedia, Airbnb, Trip.com.
Mm-hmm.
How do they stack up size-wise against Booking Holdings?
Good question. So as of around May 2025, the sources give these rough figures. Expedia Group, market cap around $21 billion, revenue about $13.7 billion.
Okay.
Airbnb, much bigger market cap, about $81 billion, with revenue around $11.1 billion.
Interesting. Higher cap, lower revenue than Expedia there.
Yeah, different models, different market perceptions.
Yeah.
And Trip.com Group, market cap around $42 billion, revenue about $7.5 billion.
Got it. So where does Booking fit in that picture?
Well, Booking Holdings, by comparison, had a market cap significantly larger than all of them, around $173.5 billion as of May 2025.
Whoa. Okay, $173 billion. That's a massive difference.
It really is. And that sheer scale is just a huge factor in the competitive dynamics. It gives them enormous financial strength.
Okay, so this is where it gets really interesting for me. With that kind of scale, but still facing those big competitors, what actually gives Booking Holdings its edge? What's their economic moat, as they say?
Yeah, the sources are actually quite clear on this. They talk about a wide and defensible economic moat built on primarily three pillars: powerful network effects, strong brand recognition and loyalty, and significant scale advantages.
Okay, break down those network effects for me. How does that work in the online travel world?
It's the classic two-sided marketplace dynamic, really turbocharged. On one side, you have Booking Holdings aggregating millions of diverse travel suppliers all over the world. And crucially, the sources highlight this includes a vast number of independent hotels, which are often harder for smaller players to sign up individually at scale.
Right. They bring the long tail of supply.
Exactly. Then on the other side, you have this massive global base of travelers using their platforms. So the more suppliers they have, the more attractive the platform is to travelers because there's more choice.
Makes sense.
And the more travelers use the platform, the more attractive it is for suppliers to list their properties or services there because that's where the customers are.
It feeds itself.
Precisely. It creates this self-reinforcing cycle, a kind of flywheel that makes it incredibly difficult and expensive for new entrants or smaller competitors to replicate that scale on both sides simultaneously.
So the bigger they get, the stronger that advantage becomes. It's a barrier to entry.
A huge barrier. Then second is the strength of their brands, particularly Booking.com, but also Priceline, Kayak. These are iconic, trusted names built up over years through heavy marketing spend.
People just know them.
Right. And this drives a really significant amount of direct traffic to their websites and apps. The sources quote, a figure around 55% of their bookings coming directly.
55%. That seems massive. What's the significance of that?
It's huge because it means for over half their business, they're not paying referral fees or advertising costs to Google or other meta search sites. That's a major cost efficiency compared to competitors who might be more reliant on paid channels.
Wow. Okay.
And they reinforce this with things like their Genius Loyalty program, which encourages repeat direct bookings.
Well, brand and direct traffic save them a lot of money. What about the scale advantages?
Well, that direct traffic saving is part of it, but their overall size just gives them economies of scale in lots of areas. Think about IT infrastructure, data analytics, running these massive platforms efficiently, and especially marketing efficiency. They can negotiate better terms with advertising platforms like Google Hotels, or just buy ads more cost effectively than, say, an individual hotel or a smaller OTA could. They also have more leverage when negotiating commission rates with their partners.
Right, the power of being the biggest player.
Yeah.
And the sources mentioned something interesting about how they handled COVID-19, not just surviving, but strengthening their position.
Yes, that was highlighted as a really key point. It shows their resilience and, frankly, strategic thinking, instead of just hunkering down during the travel downturn.
Which was brutal for everyone.
Absolutely. They actually used that period to accelerate the development and integration of their non-accommodation offerings. So pushing harder into flights, car rentals, and importantly, alternative accommodations, vacation rentals, apartments, etc.
Taking on Airbnb more directly and beefing up against Expedia's traditional strength in flights.
Exactly. It was a proactive move, and the sources suggest this helped enhance their competitive standing coming out of the pandemic. It improved customer retention because people could book more parts of their trip in one place, and it seems to have contributed to that increase in direct traffic and overall profitability post-COVID.
That's smart, using a crisis to get stronger. Okay, let's shift gears from strategy to the numbers. What do the financials tell us about Booking Holdings' health over the last, say, 3 years, 2022 through 2024?
Okay, looking at the key figures provided in the sources, you definitely see a story of strong operational recovery and continued growth post-pandemic. Revenue, for instance, grew really robustly. It went from about $17.1 billion in 2022 up to $21.4 billion in 2023, and then another jump to $23.7 billion in 2024.
Nice, steady top-line growth there.
Yeah.
How did that flow through to the bottom line, to profit?
Net income also showed impressive growth. It was $3.1 billion in 2022, grew to $4.3 billion in 2023, and then a really significant leap to $5.9 billion, almost $6 billion in 2024. So that indicates not just revenue growth, but improving profitability, better margins.
Very strong profit growth. What about the balance sheet side of things? Assets and debt.
Total assets were sitting around $27.7 billion in 2024. Total debt, though, has increased over this period. It went from about $12.5 billion in 2022 up to $16.6 billion by the end of 2024.
Okay. Debt increased by what, over $4 billion in just 2 years? Is there a story behind that increase?
Yes, absolutely. And the sources make this a really crucial point of context. That increase in debt happened at the same time as the company was returning very, very significant amounts of capital to its shareholders.
How are they doing that? Dividends?
Primarily through massive share repurchase programs, buybacks.
Okay. Buying back their own stock.
Yeah.
That is interesting context for the rising debt. So let's try and put some ratios on these numbers. What about return on equity, ROE? How does that look?
Right, ROE. So in 2022, it looked fantastic, 68.3%, really strong.
Yeah, very high.
However, and this is a big however, according to the sources, for 2023 and 2024, the calculated ROE figures are, well, they're described as highly distorted and not meaningful.
Not meaningful. How so?
The numbers get completely skewed. Like in 2023, it shows a ridiculously high positive number, over 22,000%, which is clearly nonsensical. And then in 2024, it's negative 174%.
Wait, negative ROE? But you just said they made almost $6 billion in profit in 2024. How is that even possible? That doesn't make sense.
Exactly. It seems counterintuitive, right?
Right.
But it goes directly back to those enormous share buybacks we just talked about. Booking Holdings has been incredibly aggressive in repurchasing its own stock. The sources state they'd accumulated something like $47.9 billion worth of Treasury stock by the end of 2024.
$48 billion, okay.
And the way accounting works, Treasury stock is treated as a contra equity account. It directly reduces total stockholders' equity on the balance sheet. And because these buybacks have been so massive, they've actually pushed the company's total stockholders' equity into negative territory in 2023 and 2024.
So the E in the ROE calculation, the equity denominator, is negative. And dividing profit by a negative number gives
A
you...
meaningless negative ratio, or a wildly inflated positive one if the negative equity is very small relative to profit in another year.
Got it. So the company is operationally very profitable, but this standard ratio is completely broken because of their capital return strategy.
That's exactly what the sources are saying. It's an accounting outcome, not a reflection of poor performance. The advice is to look at other profitability metrics instead, like net income margins or return on invested capital if you have it.
Okay, that's a really critical point for anyone just looking at the headline numbers. You have to understand the why behind that weird ROE.
Yeah.
What about the current ratio? That measures short-term liquidity, right?
Correct. And the current ratio looks quite healthy. It's remained comfortably above 1.0x for all 3 years, 1.86x in 2022, 1.28x in 2023, and 1.31x in 2024.
And those are generally considered good levels.
Yeah, they fall right within the typical healthy range, often cited as 1.2x to 2.0x. It suggests they have plenty of current assets, cash, receivables, etc. to cover their short-term liabilities. Plus, the sources also mentioned they had a substantial cash and short-term investment buffer, about $15.6 billion in the first quarter of 2025. So, liquidity seems strong.
Okay, good. Now, debt to equity. I'm guessing that ratio is also going to be weird because of the negative equity.
You guessed right. Exactly the same issue as ROE. Because the equity denominator is negative in 2023 and 2024, the debt-to-equity ratio is also negative and therefore not meaningful in the traditional sense.
Even in 2022, before equity went negative, what was it?
It was already quite high in 2022 at 4.49x. But again, the sources stress that for booking holdings, you have to interpret this differently, that negative DE is a direct accounting consequence of their choice to return capital via buybacks.
So it doesn't necessarily mean they're about to collapse under the weight of their debt?
Not based on this ratio alone, no. The sources point out they have very strong earnings power to actually service that debt. They mention a healthy interest coverage ratio, EBIT, over interest expense of around 12.9x, meaning their operating profit is almost 13 times their interest payments.
Okay, that's a better indicator of their ability to handle the debt.
It is. However, the sources do caution that the absolute level of debt has undeniably increased. And with negative equity rendering DE useless, other leverage metrics become more important for analysis. Things like debt to EBITDA, which compares debt to a measure of operating cash flow.
Right, comparing debt to earnings rather than that skewed equity figure.
Exactly. So the balance sheet optics, particularly around equity, are definitely unique due to the buybacks and need careful consideration.
Okay, so summing up the financials. Operationally, they look very strong. Highly profitable, growing, generating lots of cash. But the balance sheet, especially the equity section, looks unusual, maybe even alarming at first glance if you don't understand. It's driven by a deliberate, very aggressive strategy of returning capital to shareholders through buybacks.
That's a perfect summary based on the source material. Their financial strength is really in the income statement and cash flow, but you need that context to interpret the balance sheet ratios correctly.
Right. Okay. So given that performance and that unique financial structure, how does the stock market seem to view booking holdings? What do the valuation multiples tell us compared to those competitors we talked about?
Well, looking at the valuation ratios provided as of May 2025, Booking Holdings price to earnings ratio, or PE, was around 33.4x.
Okay, 33 times earnings.
Its price to sales ratio, PS, was about 7.42x. And its enterprise value to EBITDA ratio, EBITDA, which includes debt in the value, was roughly 19.9x.
Got it. And how do those compare to the average for Expedia, Airbnb, and Trip.com?
When you line them up against the peer averages provided in the sources, Booking Holdings trades at a pretty noticeable premium across all three metrics.
A premium, meaning higher multiples.
Yeah. The peer average PE was around 23.1x compared to Booking's 33.4x. The average PS was about 4.91x versus Booking's 7.42x. And the average EBITDA was roughly 14.77x compared to Booking's 19.9x.
So significantly higher across the board. Investors are paying more for each dollar of Booking's earnings, sales, and operating profit than they are for its main competitors on average. What does that premium valuation suggest?
It strongly suggests the market is pricing in expectations of superior future performance from Booking Holdings compared to its peers.
Like faster growth or higher profits down the line.
Exactly. Investors likely believe Booking has stronger growth prospects, maybe higher potential profitability, or just a more resilient, defensible market position, that wider economic moat we discussed earlier.
And what factors might be driving that belief?
The sources point to several likely contributors. There are clear market leadership, and those powerful brands, their consistent track record of strong financial performance, visible progress on strategic initiatives like the Connected Trip and their AI integration efforts, and potentially stronger operating margins compared to peers.
Okay, so the market sees the strength and is willing to pay up for it. But the flip side of a premium price is usually high expectations, right? If they stumble, is there more downside risk?
That's precisely the implication. A premium valuation means the market has already factored in continued strong execution and growth. So if their growth were to slow down more than expected, or if they hit major roadblocks with their strategies, or face unexpected macro headwinds, the stock price could potentially be more sensitive to that negative news, more vulnerable than the stocks of peers trading at lower, less demanding multiples. High expectations cut both ways.
Makes sense. Okay, let's look ahead now. What are Booking Holdings' main strategic priorities? What are their big plans for growth beyond just riding the general travel market recovery?
Their strategy, based on the sources, is pretty multifaceted. A core element is just continuing to enhance their existing brands, make them the most trusted, most convenient platforms out there. They specifically mention wanting to grow market share in the U.S. market.
Okay, building on that brand strength.
Yeah.
And that connected trip concept we talked about earlier.
Okay.
Is that still central?
Oh, absolutely central to their future growth narrative. They are investing heavily and working aggressively to make that vision a reality, integrating accommodation, flights, ground transport, tours, activities,
Variety package,
and critically enhancing their payment platform. They want to be a versatile payment intermediary across all these different travel verticals, making it seamless to book and manage the entire trip within their ecosystem.
And you mentioned technology and AI being key.
Yes, technology and specifically AI are positioned as fundamental enablers for this whole strategy. They're pouring investment into leveraging AI for much deeper personalization for users.
Tailoring offers and stuff.
Right. And also for improving operational efficiency through automation. The sources mention customer service as a key area there. Plus, developing innovative new products and features like the AI trip planner or that penny assistant they mentioned.
Are they also focused on extending the types of things you can book beyond just hotels?
Definitely. They are actively growing their alternative accommodations, business apartments, vacation rentals, which puts them in more direct competition with Airbnb.
Right.
And they're also focused on enhancing their flight offering, making it more competitive. Improving loyalty programs like Genius is also a constant effort to drive that valuable repeat direct business.
Okay, lots of moving parts. And wasn't there also mention of a big internal program, something called the Transformation Program?
Yes, that's significant. It was announced back in November 2024. The sources describe it as a large-scale, multi-year initiative. It's focused on modernizing their underlying systems, optimizing things like procurement and their real estate footprint, and it also involves some workforce reductions.
Okay, so cost cutting.
Partly, yes. The stated goal is to achieve somewhere between $400 million and $450 million in annual run rate savings by the end of 2027.
That's a big number.
It is. But, and this is a key point highlighted in the sources, a significant chunk of those savings is specifically earmarked for reinvestment.
Reinvestment where?
Into those high-priority strategic areas we just discussed, particularly AI development and building out the connected trip vision.
So it's not just about slashing costs for the sake of profit margins, but more about freeing up capital to fuel future growth initiatives.
That seems to be exactly how they're positioning it. A proactive move made from a position of strength, aimed at driving efficiency and funding the next wave of innovation. Of course, executing a program this large always comes with risks.
Sure, big transformations are never easy. What about their own long-term financial targets? What are they aiming for?
Assuming, a reasonably normal travel environment, their stated long-term ambition, according to the sources, is for constant currency growth of at least 8% for both gross bookings and revenue.
Okay, 8% plus top-line growth.
And importantly, growth of at least 15% for their adjusted earnings per share, EPS.
15% plus EPS growth. So they expect profits to grow significantly faster than revenue.
That's right. It suggests they anticipate continued margin expansion, benefiting from operating leverage, those transformation program efficiencies, and likely the ongoing impact of share buybacks reducing the share count.
Okay, that's the long-term picture.
Yeah.
What about the nearer term, say for fiscal year 2025? What are analysts generally expecting based on the sources?
The analyst consensus seems pretty well aligned with the company's own ambitions. The sources suggest analysts project revenue growth for FY 2025 somewhere around 7.8% year over year.
Close to that 8% target.
But they expect stronger adjusted EPS growth, forecasted in the range of 16.7% to maybe 16.74%.
Again, significantly outpacing revenue growth.
Exactly. It suggests Wall Street believes they can deliver on that operational leverage and perhaps factor in benefits from the transformation program and those buybacks boosting the per-share earnings.
That faster profit growth story is definitely compelling. Switching slightly, what about recent news or events? Anything significant in the last, say, 6 months or so that's shaping the outlook?
Yeah, there have been several key data points and announcements. First, their Q4 2024 and full year 2024 results, which they reported back in February 2025, came in strong and beat expectations.
What will those show?
They really showed resilient travel demand continuing and solid execution on their part. Key Q4 stats mentioned were things like 13% growth in room nights booked, 17% growth in gross bookings, 14% revenue growth, and a really strong 30% jump in adjusted EPS for the quarter. Full year 2024 adjusted EPS was up 23%, so positive momentum.
Okay, strong end of 2024. What about the most recent quarter, Q1 2025?
Q1 results reported in April were also generally positive and beat analyst expectations. Room nights grew 7% year over year, hitting over 300 million, which was a Q1 record for them.
Wow.
Bookings were up 7%, revenue up 8% to $4.8 billion. Adjusted EBITDA, a measure of operating profit, up 21%, and adjusted EPS up 22% to $24.81. They also noted their alternative accommodation segment was particularly strong, growing 12%.
Those still sound like pretty solid operational results. But I thought I heard something about management sounding a bit cautious.
You're right, they did. Despite the strong Q1 numbers, management offered a somewhat cautious outlook for the rest of the year. They cited potential risks from the macroeconomic environment and geopolitical instability. This led them to provide a slightly wider guidance range for the full year than maybe some expected.
So tempering expectations a bit.
A little bit, yeah.
Ah.
And the sources emphasized this, the high end of that new guidance range still essentially aligned with previous expectations and their long-term goals. So it's more like a balanced view, acknowledging the external uncertainties while the core business continues to perform well.
Okay, managing expectations. Any other recent news highlights worth mentioning?
Well, there have been continued updates on that transformation program and their AI progress. They've confirmed the savings targets, talked more about using AI for automation, especially in customer service.
Mm-hmm.
And they've actually launched tangible AI products like Priceline's AI-powered Neighborhood Edition that came out in April 2025. So showing concrete steps on the strategy.
Good to see actual products coming out.
Absolutely. And the other big theme is their continued massive capital return program. A new $20 billion share repurchase authorization was announced in January 2025.
$20 billion.
Yeah. And just in Q1 2025 alone, they returned $2.1 billion to shareholders through buybacks and dividends. They also increased their dividend payout significantly in March 2025 to $9.60 per share.
So doubling down on returning cash.
Exactly. It reinforces just how much cash their business generates and their commitment to shareholder returns. And of course, it provides more context for that whole negative equity situation we discussed. They're actively choosing to send cash back rather than build up the equity base.
Okay, that covers the strategy and recent performance really well. Now, we have to talk about the potential downsides. No companies without challenges. What are the main risks Booking Holdings faces, according to the sources?
The sources, especially the summary drawing from their 2024 annual report, really hone in on several key risk categories. The top three that get consistent mention are market risks and competition, operational risks and technological change, and regulatory risks.
Okay, let's maybe unpack those top three a bit.
Yeah.
Market risks and competition first.
Right. So first, the travel industry itself is just inherently sensitive to economic cycles. Recessions, inflation, and global events like pandemics or geopolitical conflicts can hit demand hard.
Sure, travel is often discretionary spending.
Exactly. And then there's the competition. It's described as intense and constantly evolving. It's not just from their traditional OTA peers like Expedia and Airbnb, but significantly from meta search engines, especially Google, with its growing suite of travel products that potentially disintermediate OTAs. And also, there's the ongoing push by hotels and airlines themselves to encourage customers to book directly on their own websites, cutting out the middleman.
So they're getting squeezed from multiple angles, other big platforms, tech giants moving into their space, and even their own suppliers trying to bypass them.
That's a good way to put it. Pressure from all sides. Second big category is operational risks and technological change.
What does that cover?
Well, Just managing the sheer complexity of running a global platform with multiple brands at this enormous scale is inherently challenging. They also rely on various third-party providers for some services, which introduces dependencies.
Okay.
And critically, they have to keep up with incredibly rapid technological changes. Failing to innovate fast enough or adapt to new technologies, including the sources explicitly mentioned, the challenges and opportunities around generative AI could really hurt their competitive position.
You mentioned AI as an opportunity, but how is it a risk here, beyond just falling behind?
That's a great question. The sources point out that while Booking is investing heavily in AI, the technology itself brings new risks. There are concerns around data privacy and security, the potential for bias to creep into AI algorithms,
Yeah, we hear about that.
and just significant legal and regulatory uncertainty. Governments everywhere are still figuring out how to regulate AI, what the liabilities might be, so it's definitely a double-edged sword, huge potential, but also new complexities and risks to manage.
Right. Okay, and the third major risk category?
Regulatory risks. This is a big one for a global company like Booking. They operate in so many different countries, and they face this incredibly complex and generally tightening regulatory environment.
What kind of regulations are we talking about?
Things like evolving data privacy laws. GDPR in Europe is the classic example, but similar rules are popping up elsewhere. The introduction of digital services taxes in various countries, which directly targets companies like them. And, maybe most significantly, heightened antitrust scrutiny from regulators around the world.
Antitrust, because they're so big.
Exactly. Concerns about their market power, their commission rates, their contracts with hotels, like rate parity clauses. These are under the microscope in multiple jurisdictions. The sources actually mention a specific example, a draft decision by the Spanish Competition Authority, which forced Booking to set aside MoneyBook, a loss accrual, in 2023.
Wow, so this isn't just a theoretical risk. It's already having tangible financial impacts and could lead to changes in how they operate.
Precisely. Regulation is a very real, present, and probably growing challenge for them.
Okay. And does the SWOT analysis summary in the sources basically echo these points?
It does, yeah. It pulls it all together nicely. Strengths are what we've discussed. Dominant market position, that moat, strong financials, global reach, tech focus, high direct booking rate. Weaknesses include that negative equity structure we unpacked, their dependence on the health of the travel industry, those high marketing costs, even with direct traffic, and just the complexity of running the business.
Okay.
Opportunities are things like continued market growth, especially in emerging markets, successfully monetizing that connected trip, using AI even more deeply, growing alternative accommodations further, and reaping those transformation program savings for reinvestment.
And the threats?
Threats are basically those key risks again. Intense competition, peers, Google Direct, the tough regulatory and legal landscape, antitrust, privacy, tax, potential disruption from new technologies, macro and geopolitical headwinds, and those specific risks related to AI development and deployment.
That gives a really clear, comprehensive picture of the challenges and opportunities. Just a couple more quick points to round things out. Who's actually leading the company day to day, and who are the major owners?
Well, we mentioned CEO Glenn Fogel earlier. His long tenure starting back in 2000 and his background in M&A and strategy before becoming CEO are definitely noteworthy. It highlights this blend of strategic deal-making and now a heavy focus on technology and the customer experience.
Okay, experience leadership. What about ownership? Who owns a big chunk of the stock?
As is common with large public companies, it's mostly institutional investors. The sources mention the Vanguard Group as the largest reported institutional shareholder, holding around 9.1% of the stock as of March 2025.
Vanguard, yeah.
High institutional ownership like that generally signals a degree of confidence from the big market players.
Right. And finally, one last area, ESG. Environmental, social, and governance factors. How does Booking Holdings stack up there, according to the sources?
The sources provide some data on that, referencing an ESG risk rating from Sustainalytics, which is a well-known rating agency.
And what did the rating say?
As of late 2024 or early 2025, Booking Holdings received a rating score of 14.8 or 14.77. The numbers are very close. This score places them in the low-risk category according to Sustainalytics scale.
Low risk. Is that good compared to others?
Yes, it's considered favorable. They also ranked pretty well within their specific industry group, 72nd out of nearly 950 companies. The report summary indicated their exposure to material ESG issues was rated low, and importantly, their management of those risks was rated strong.
Okay, so what does that low risk rating actually mean in practical terms? Why should someone care?
From an investor perspective, a low-risk rating from a reputable agency like Sustainalytics is generally seen as a positive sign. It suggests the agency believes Booking Holdings is effectively managing the ESG issues most relevant to its business.
Like what kind of issues?
For a tech and travel company, that would likely include things like data privacy and security, human capital management, employee well-being, diversity and inclusion, and business ethics, corporate governance. The strong management score reinforces the idea they're handling these areas well.
And that matters because?
Well, it can enhance the company's reputation, potentially reduce certain operational or regulatory risks down the line, and it definitely appeals to the growing number of investors who specifically look for companies with strong ESG performance.
Got it. Okay, I think we've covered a huge amount of ground. This has been a really thorough look at Booking Holdings, drawing straight from the source material. Let's try and distill it all down now. Can you summarize the concise bull case and the concise bear case based on everything we've discussed?
Absolutely. Let's boil it down based strictly on the sources. The concise bull case goes something like this. Booking Holdings is the dominant global leader in online travel, protected by a wide, multifaceted economic moat built on those powerful network effects, incredibly strong brands driving direct traffic, and significant scale advantages.
Okay. Leadership and moat.
They have a proven track record of consistent growth and impressive profitability, generating massive free cash flow, which they strategically return to shareholders via buybacks and dividends.
Strong financials, shareholder friendly.
Looking forward, they have multiple clear, ambitious strategic levers for growth. Fully realizing that connected trip vision, leveraging AI for personalization and efficiency, expanding further in alternative accommodations and flights, and benefiting from the transformation program's savings to reinvest in these priorities.
Growth drivers are there.
Plus, they're fundamentally well-positioned to benefit from favorable long-term global travel growth trends, and they're led by experienced management with a demonstrated focus on creating shareholder value. That's the bull story in a nutshell.
Okay, sounds compelling. Now, what's the concise bear case, drawing from the same sources?
The concise bear case highlights the significant headwinds and risks. First, they face intense and constantly evolving competition from multiple directions, strong OTA peers, tech giants like Google encroaching on their turf, and suppliers' ongoing efforts to drive direct bookings.
Competition is fierce.
Second, there are substantial and arguably increasing regulatory and legal risks across the globe. This includes complex antitrust investigations in multiple regions, evolving data privacy rules, and new digital taxes, all of which could impact their operations and financials, the Spanish case being a prime example.
Regulatory pressure is real.
Third, their business is inherently sensitive to broader macroeconomic downturns, inflation impacting travel budgets, and geopolitical instability disrupting travel patterns.
Macro risks.
Fourth, executing their complex, ambitious strategies, fully integrating the connected trip, deploying AI effectively and responsibly at scale, and successfully implementing that huge transformation program carries significant execution risk. Things could go wrong or take longer than planned.
Strategy execution is hard.
Fifth, the stock trades at a premium valuation relative to peers, meaning expectations are already high, making it potentially more vulnerable to disappointment if growth slows or they hit setbacks.
Valuation risk.
And finally, while strategic, that unique balance sheet structure with negative equity resulting from buybacks can be a concern or red flag for some investors. Plus, the emerging risks around AI privacy, security, bias, legal liability add another layer of uncertainty for the future. That's the essence of the bear case.
That gives a really clear, balanced summary of the core arguments on both sides, straight from the material we reviewed.
Yeah, that's the goal, right? To give you that nuanced understanding. It's about looking beyond just the headlines or the brand name you use to book a hotel. It's about grasping the specifics of their powerful business model, really understanding how those competitive advantages like network effects actually work, seeing how they strategically manage their finances, including those slightly unusual aspects like the massive buybacks impacting the balance sheet ratios, and analyzing how they're responding strategically to a market that's always changing.
It really is a complex picture, but also a fascinatingly powerful operation they've built. Okay, so here's a final thought, something for you, our listener, to consider as you process all this information we've unpacked today.
Okay.
Given Booking Holdings' immense scale that deeply entrenched network effect moat they possess, and their clear strategic investments in potentially game-changing areas like AI and that integrated connected trip vision, can they actually continue to widen their lead, maybe even make their competitive position almost unassailable in the coming years? Or, on the other hand, will the combined pressures from increasingly active regulators around the world, from powerful tech giants like Google that keep pushing into travel, and from that persistent threat of suppliers trying to win back customers directly, will those forces eventually challenge booking's dominance more significantly than they have managed to so far?
That's the multi-billion-dollar question, isn't it?
It really is. Something to think about.